I don't know if I should bow to these three fantastic fund managers who have agreed to come. I'm so pleased and actually thrilled to have all three of them. All three are very experienced syndicators and fund managers, and I'm really excited to have them on this panel. So before we start doing introductions, let me briefly introduce myself. I see a lot of familiar faces and not faces, sorry, familiar names. I can't see your faces in this webinar. And so for them, this might be a repeat, but for those who don't know me, my name is Badri Malinor. I'm a co-founder at Avestor. And just some brief background about myself. I was an exec in a Fortune 500 company, retired about 15 years back, was running a team of about 300 people across multiple continents. That got pretty old. I'm sure some of you can relate to that. And I was living a retired life when my good friend of mine, Sanjay, came and we came up with this idea for Avestor, and I came out of retirement. A couple of tidbits. I have invested in almost every possible asset class out there, invested in venture capital companies, ran a hedge fund for index stock options, invested in about 36 startups, and commodities, gold, bonds, the works. So I feel like I can talk from a perspective for multiple asset classes. I always like to start with a favorite, some interesting fact about yourself. My goal is to visit every country in the world. I've been to about 70 countries and off to Galapagos for the next trip in a few days. So that should be interesting. My kids are trying to convince me to do some scuba diving. I don't know if I'll quite do that. I think I'll just settle for snorkeling. With that, thank you all for coming. And very briefly about Avestor. This is not about Avestor. If you want to learn more about Avestor in specific and you want a demo, this is definitely not a sales presentation. If you go to our website, there'll be ongoing webinars every couple of weeks. You can join and get many of the detailed questions about customizable funds are answered. But very briefly, Avestor is a platform for creating customizable funds, which completely changes the rules of the game, both for fund managers and for investors, allowing you to pick custom portfolios from an investor perspective and from a sponsor perspective. It gives you amazing flexibility in the business model. But we can get into some of those as we get more questions. And with that, let me start with asking the panelists to introduce themselves. I'll start with Madhavi. Madhavi is such a pretty name. Full disclosure, my wife's name is Madhavi too, so I'm biased. So let's start with Madhavi. Madhavi, if you want to introduce yourself, talk a little bit about your fund and your background, what you plan to accomplish with your fund, your strategy, and one or two fun facts about yourself, and then we'll go to the others. So, Madhavi, you're muted.
There you go. You can hear me now?
Yes.
Thank you so much for that kind introduction, Badri, and talking about Avestor platform. So, Madhavi is a pretty name, and the way I like to tell people to pronounce if they have difficulty pronouncing is it has math in my name. So it's Madhavi, like Gary V. And that kind of helps because I'm a math major, I'm a numbers person, I'm very analytical. So that goes with my persona as well. So yes, it's a beautiful name. I like it too. So I am, my name, of course, you can see, Think Outside the Stocks. That's my fund, that's my company. And it's not just the out of the stock, but out of the box strategy as well. In my fund, I focus on different commercial real estate focused asset classes. So not just single like apartment or anything, but apartment, industrial, ATM, and we are also looking at bringing in mobile home parks, probably self-storages, etc. So that is a diversification that I'm providing in my fund, and thanks to Avestor, I'm able to do it very swiftly. So that's about my fund and about my company. About me, I have been in IT profession. 15 plus years, top 5 consulting job, left my job and started my reverse way into financial freedom with Think Outside the Stocks. And what I'm driven is basically when I found out that, these are the strategies, these are the out of box strategy exist in the world. And people don't know about it, especially the first generation immigrants, IT folks, doctors who do not have busy professionals time for it. So I use them. I use twofold strategy to help them. It's a efficient strategy with infinite banking, which could be the fun fact, was one interesting fun fact, because not many people do that. I love educating. So that's the first fold. And the second fold is, of course, the commercial real estate focused investment strategies. So that's about me.
Very good. Thank you, Madhavi. Let's go ahead clockwise, I guess. Well, it's my clockwise. You probably have no idea where you are next. So, BD, if you want to go ahead next.
Yeah, no, absolutely. My name is Badri Fouad. I go BD for short. Just a little background about me. I am electrical and computer engineering by training. I started my career in semiconductor, had a successful career for 24 years as a chip designer, worked on really interesting stuff that went into rockets, that went into cell phones, that went into all sorts of things. That being said, I was an accidental landlord and kind of stumbled across real estate early on in my career that really kind of lit the fire inside me to just really become a real estate investor. Fast forward 24 years, while I continue to invest, I decided to retire from high tech, mainly to focus on my health, my family, and doing the type of things that I like to do, and really kind of go in full throttle in my investing career. As I started getting into more commercial real estate, a lot of my friends said, "Hey, we would like to kind of shadow what you're doing," and that's really what started Bluestone Flagship Investors. So thanks for you, Badri, and the investor team for being able to provide a platform that really kind of suits more of the need of a fund manager. Frankly, did not set out to do a fund. It was really about investing and pooling capital from a lot of friends, clarifying, bringing in good deals and investing together, and kind of evolved itself into that. And it hasn't been possible without the Avister platform. A little background or interesting fun facts about me. I'm passionate about teaching and giving back. I donate about 25% of my time for youth education, where I'm actually teaching kids both in person as well as online in third world countries, as well as some needy geographies and zip codes here in the Bay Area where I live. Father of two, and I do enjoy many things. Travel is definitely one of them. Off to a trip soon, but I'm also passionate about exotic cars. I would call that my expensive habit, or where I'm part of several different car clubs that I like to do for fun.
Hey, sometimes they're the best investment, right? I mean, they're a lot more stable. So
you do meet a lot of interesting investors in that domain, that's for sure.
Thank you, VD. Appreciate that. Jeff, it's all you.
Yeah, well, I'll start out with my fun fact. I have 3 grown children and 4 up and coming grandchildren. And I used to teach scuba diving, so you really should take your kids up on the scuba diving. Snorkeling just doesn't do it. Getting down to the bottom of the ocean is where it's at. So used to do that for quite a few years. I call myself a recovering syndicator. For the past 12 years, I've been syndicating multifamily and student housing, and now I've moved over to the dark side, which is the private equity side of it. And fortunately, I bumped into a investor a couple of years back and realized that I could create a fund and have diverse asset types within the fund. And so I have my fund set up so we can bring in different types of offerings, and that way investors can self-diversify. Some opportunities may be higher cash flow, some may be higher capital appreciation, but just different environments, and help to protect investments by diversifying across the different asset types, different regions, different sponsors. And I'm having a heck of a fun time helping educate investors on different opportunities and different things that are out there. And I think, all of us are doing that, where we're helping educate investors on different opportunities outside of the stocks and outside of the normal markets. And I'm glad to be here and have a conversation with you today.
Thank you so much, guys. That's a great introduction, some interesting fun facts. just building on the fun fact, I did get my scuba license. So I have seen what life is like underwater, but I don't enjoy it. I don't like, I'm not very comfortable underwater. Anyway, again, we are getting into a lot more detail than people probably want or know or care. So let's dive right in. Just as a reminder, please put your questions in the Q&A session, in the Q&A panel, not in the chat window. So just some general questions to start with, and we have had a ton of questions which came in when people registered, and we'll go through that in categories. Yeah. So any of you can take this question. Why did you decide to go with, you answered some of it in your introduction too, but if you want to build on it, why did you decide to go in the fund of funds route as opposed to just doing one deal at a time or syndications? Or I mean, if whoever wants to go can go, or all three of you can take turns.
Well, I'll start out on that one. I did my first deal with an SPV, which is a single purpose vehicle, where I had raised money within the single purpose vehicle. And there's a lot of complication with that, where first you're waiting for the PPM to come in from the deal so you can form your PPM around it. And there's a big time lapse, extra expense, a lot more hassle creating the SPV and going in that way, where having a customizable fund, it makes it much easier to do it and less cost, which, you know, ends up filtering down to everybody. So you want to keep your costs down and be able to do it as quickly as possible. The other thing, it's less worrying about the taxes and doing other deals. The first deal I did, though, I actually did where we went straight into the deal, where I went in as a co-GP. And that adds other issues as far as compliance with SEC rules and what you're allowed to do. And also, your investors are exposed to the sponsor, where they have the names and information of your investors. Now, even if you totally trust the deal sponsor, sometimes people's names get into their mailing list, and investors have the right to go straight in if they want next time into those deals. So going the fund to fund route protects your investors, keeps your investors to your fund, and you don't have to worry as much about those compliance issues.
Yeah, and I can add to that. Great answer, Jeff. I mean, that's one of the things that I was focusing on as well, right? But stepping back a little bit, I'll answer that question in a kind of a multifold way, right? The first fold is the SEC compliance, right? Once I realized that, there's, co-GPs and there are people, investor relationship, and there are 10 people who are co-GPs for capital raise. And if they are looking at investor relationship, how many people do you really need to create that newsletter, right? So that's kind of questions when it starts coming down, it's going to be difficult, right? So for me, that staying in the white line is very, very important. The trust and transparency is one of my key pillars, right? So I wanted to be clear. I wanted to sleep well. So that was my first reason why I went for the fund of fund model, right, itself, right? And then what happens is the second layer of it after that, whether to be able to do it legally. So that's the fund of fund model. The second layer of it is the investors. My second focus, my focus is investor, pure, simple, right? Now for investors, if you go in a fund model and they're used to seeing the investments coming there and making that decision on them, and if you go a blind pool model, suddenly the decision is taken away from them. So they don't like it. And, some of your investors can actually back out. So I found that without impacting that, I was able to help them and still be able to choose what investments they want to go in or not, right? And of course, didn't want to manage that myself and what the complexity that comes together with it. Avestor is doing beautifully. That's one of the things, right? The next layer, I would say that, again, talking about investors, right? My focus is investors, right? So as a fund manager, by the way, if you're looking at, thinking of becoming a fund manager, for being a fund manager is not an easy task. there's a lot of nuance to it. And, Avestor helps in a lot of way to kind of help you navigate through it. So this is my first time fund manager. I have been in other programs like Richard Pennington program and, other programs where they talk about fund management a lot, right? So it's important to know that what do you want to focus on? So for me, my priority is the investment priority, their education, providing them, enough value so that there is, I work in fund of fund model, right? So to educate them to do that due diligence on investment is massive. The massive amount of time is spent doing the due diligence, finding the investments and bringing to the investors, right? So I wanted to focus on the task that I wanted to focus on and let the experts handle the back end of it. So these are the few reasons, I went in. And of course, as an investor priority, they having the dashboard, having the 1K one, that's really what they like. So these are a few of my things that I would add to.
Wow, what a great build-up. Do you want to give the grand finale, Vidi?
I'm not sure it's a grand finale. I don't think it can get better than this between what Madhavi and Jeff. But I'll give you a little bit perspective how I backed into it. I came at this more from an investor standpoint. The journey for me is all about the investor because I was looking to invest my capital, go and do due diligence on deals, and friends say, hey, would like to kind of join in. Looked into aspects like an SPV and scalability of that. But at the end of the day, I've realized that majority of the work, after you qualify and you say, this is really a good deal where I'm ready to put in my own capital to open it up to the rest of the investors, is how do you offer them a single platform they can go to every time, instead of every time you're sending them to a different sponsor website, have them go log in, create, and then tracking it. Frankly, if when I started investing and you're in 1 or 2 or 3 syndication, it's manageable. But when you get over 10 and it's in different sponsors, portals, it starts to get really, really messy. And at some point I had to create an Excel sheet just to track how much capital, I'm invested in which sponsor. So all of that just goes away with Avestor because it's a single platform, from an investor standpoint. It's a single platform that investor can plug in. They get to see what are the best deals that are vetted that I'm looking to deploy capital in. They can decide on a deal by deal they want to participate or not. And they don't have to deal with having to go and set up accreditation at different sponsors and log in at different sponsors. And then they get to really track where their money, where the capital is invested. For me, it's really like the ideal platform. It's like your E-Trade account. You can buy any security in your E-Trade account. So the Avestor, for me, it becomes, from an investor standpoint, is like the E-Trade account for them to really invest into, quality deals where they can track how the deals are doing, get all the reports on the deals, get their K1s from the deals. Everything they need is in one platform. So for the investor experience standpoint, it was really the main driving factor for me going into the Avestor and enabling them to pick and choose which deals they want to be part of.
Excellent, excellent. Great answers, everybody. So at the end of the day, I mean, all of you do charitable causes, but running a fund is not a charity. At least I don't believe you're running it that way. So one of the questions is, how do you make money with the fund of funds? And I know the answer can be different for each fund manager can make money in different ways. And one of the things which Avestor does enable you to make money in a variety of ways, legally, of course. So why don't we go around and maybe talk about how you're making the fund economics work, and maybe I'll add a few things after the three of you go. Whoever wants to go first.
I can go first on this one.
Go for it, Madhavi.
So I think most important thing is to understand is that, syndicator were used to doing the co-GP way, right? So fund of fund, though it's not recent, it has kind of taken up a little bit more. It's about creating or educating the syndicators as well that, how the fund of fund platform works. And a lot of syndicators have been doing it for a long time in SPV, and they're open to it, kind of changing it. But the dynamics needs to be calculated, right? So for example, it's very simple, right? If you are going as a 50,000 investor, you get a certain kind of a pref and certain splits. If you go as a 500K investor, even if it's not a fund, if you're, just a 500K investor, you're going to get a different split because now you're bringing more money to the table, right? So your pref is going to change, your splits are going to change. And I love examples, I love numbers, right? So I'm just going to give you an example. If you are as a retail investor, 50K investor, 7% pref, and you have, about 70-30 split on the partnership. Let's just keep it simple, not make it complicated with waterfalls and all, right? As a fund manager, if you have that 8% pref, and you have, instead of that 70-30 splits, now 80-20 split, now you have that 10% extra carve out, right? And 1% extra in the pref. So in your documents, which is on Avestor platform, is a simple 2-page document. It's not a 100-page PPM document. You're just stating there, and that's the beauty of it, because I love the transparency for investors. You're going to state that this is what the fund is going to get, which is the extra split, the 8% pref and 80-20, and it's going to come down to the investors exact same way, if it is not any better, that the retail investors, that original investment is getting. That's a 7% pref and the 70-30 split. And I like to, as a fund manager, keep it same so that the retail investors are not compromising on their returns. So that's simply how, that pref, extra pref and extra in the back end, that as a fund manager, I get to keep and make money on. At times there is some due diligence fees also that you can charge for as an additional, because you need some money upfront to keep the lights on, right? So again, it's about educating the syndicators if they're not doing it in a certain way, and B, educating your investors that we are keeping this extra, but it's not coming out of your bucket, but it's the bucket that we have created with the partnership. And sometimes there is even more negotiation. We have started as a community, where we started working as a group, where we are getting, together to raise this capital together and negotiate even more. So that's essentially what you're giving back, and that's what you're getting to keep as a fund manager. And then you can take a look at a few other things, right? Like getting some expenses paid off from the sponsors, etc. And Badri, I like the calculator that you have, which kind of creates that and shows that as a fund manager, if that split occurs, what is that going to be at the end for the fund manager?
Very good. Before I let others answer, one of the things we do is we negotiate preferred splits with top tier sponsors so that you collectively, if let's say 4 or 5 Avestor fund managers raise 200K each, and then you're getting that $1 million split, collectively, as opposed to each Avestor fund manager having to raise $1 million. And our goal is to build relationships with sponsors from a wide range of asset classes: industrial, mobile, multifamily, self-storage. So, but I'll talk a little more about that in a second, but let's see if BD or Jeff want to talk about their ways of making money as a fund manager.
Go ahead, BD.
No problem. So again, there's definitely different models. In Bluestone flagship investors, how we choose to go about this is very straightforward. There's just a flat assets under management fee that is transparent to the investors, that every investor, when they sign the PPM for the fund, pays. And as far as the pre-negotiated rates that Madhavi has said, for our standpoint, that's just a pass through to the investors. The biggest way I make my money in the fund, frankly, is my own capital invested in the deal. And I know, other fund managers do invest as well. But for us, straight from the get-go, we said, we're only bringing deals where, we're, as a fund managers, are interested in investing in. And we are getting the benefit out of those deals by pooling in larger capital into the deal. So for me, really, where it makes the biggest amount of difference is that negotiated return that not only I get to enjoy on my investment, but my investors within the fund get to enjoy. And they understand that, I am doing extra work beyond just, there's due diligence, there's networking, there's significant hours that I get to spend with these fine 2 people here on the panel. Like we already have spent 2 hours already this morning together working on due diligence and talking about different deals. So our investors understand there's a lot of work on the back end, the fund management, the paperwork, the taxes. There's a whole lot of stuff that actually goes into fund management. And for me, that they understand that there's a fee that has to be associated, which is the asset under management fee that they pay as a part of the sweat equity for me to really run the day-to-day.
And to kind of finish up as far as what both of these panelists have said, I mean, there's many ways to do it, but essentially it is, we do negotiate better terms, and as part of Esther and as well as a part of a connected community that we're involved with, we do negotiate better terms for the funds. And my goal is to make sure that my investors receive at least equal to or better than what they would get if they would go straight in. But what investors need to realize is what service we're actually providing, as what BD said and Madhavi said, the amount of due diligence that we're doing to protect the investment, to de-risk investments is amazing. The number of hours that we're putting into these things. And that's one of the things that I'm afraid that passive investors don't do on their own. They may not have the knowledge, the education, or the ability to do all the different steps that we're going through. Not only that, considering we were on the phone for 2 hours today, or on Zoom for 2 hours today with one of the sponsors, if somebody was coming in with a 50K investment, he would have hung up a lot earlier. They put up with a lot from us as far as our probing into their business and into their life, because we are looking to de-risk the investment as much as possible and protect everyone. So we are putting a lot into these, and we're still doing it where the investors are getting similar to what they would do if they would go in, and they still get our service. So
yeah,
No,
if I may add to what Jeff said, Jeff brings a very, very important point, right? And a lot of capital raise partners, when they're going to the fund route, the fund of fund route, this is the one of the fear that they have, that is my investor going to agree to that I'm getting that fees paid. So most of your investors are going to understand this. There is going to be some pushback, and you can try to explain that they are actually we are actually providing that highly vetted, the questions that you don't even know what to ask, or you'll not get answers. Running background check, for example. So how can you run a background check if you're investing 50K, right? So those are the things, that additional service, which is sometimes they don't even understand what level of details we have gone in our due diligence, and how complicated questions that they don't even understand that we have asked to get this deal to them. So if you have one or two investors that they don't understand it, that's just not the worthy of that relationship, and they will basically might go directly to that investment, which is okay, because they are not going to get your next investments, that thoroughly due diligence done investment. So make that clear to them. So if you have that fear that your investors won't understand it, help them understand with this kind of material.
Excellent. So this goes to a kind of a related question. I'll go ahead and address that before we move on to a few more questions. So one of the questions is, Dave asks, hey, I'm involved in mobile home communities. Would I have an opportunity to present this to other fund managers? And yes, part of what we do, like I said, we have these deal sharing Tuesdays which is, we give priority to existing investor fund managers, but we definitely invite external fund managers, external sponsors to come in, like I said, from a variety of asset classes. There are some requirements, a checklist you have to go through. We can discuss it more offline. You're welcome to present it to the fund managers, but there are 3 key points. One, you have to give collective terms to investor community. So if 5 fund managers collectively raise $1 million, you give the $1 million term. 2, the fund manager should make at least 10% of the capital raised, preferably more. And 3, going back to the point which Jeff and Madhavi said, the investor, even if they come directly to you, should not be getting a better deal than if they come through the fund manager after the fund manager takes the cut, if that makes sense. So those are some basic criteria before we allow you to present to more than 100 investor fund managers and rapidly growing. Yeah, so we are welcome. You're more than welcome to reach out to me, and I can tell you how the dynamics of that works. Yeah. So we'll switch on to how do you choose deals and operators and things like that. But before we go there, let me take one question, and I'll let some of you jump in too. There were some specific questions on what are the differences between this and XYZ software. I'm not going to mention names of syndication software. There's plenty of syndication software out there. And let me take a quick shot at that, and then we'll go to some general questions about market. How do you find deals and things like that? So comparing Avestor to a syndication software is like really comparing, for a lack of a better word, a steering wheel or a clutch or a brake to a full automobile. I mean, I don't know, I'm just making up this analogy, right? We are not in the car parts business. I want to be very crystal clear about it. We don't want to be just a software platform. That was never the intent. The intent is to provide a comprehensive solution which includes strategy consultation, legal, accounting, taxes, audits, fund insurance. We are just in the process of negotiating fund insurance for managers, finding you deals, giving you a CRM, giving you marketing collateral. It's a completely different ballgame. We become your business partners as opposed to, hey, here is a software platform, go for it. So really, it's not fair for us or for a software platform to be compared with Avestor, because that's a small piece of what we offer. I can go into a lot more detail in this, but again, this is probably better left for a product webinar. But in case the three of you want to comment on any of that, yeah? A mastermind, for example, is a core part of it. I mean, sometimes you go pay $20,000, $50,000, $30,000 for just a mastermind. We have mastermind, we have training sessions, we have discounted service providers who give highly discounted rates, and we help you with a whole range of how to run your business. Because frankly, we charge the AUM-based fee, and if you don't grow, we don't grow. So we are really, really not only financially, but morally motivated to help you grow. I mean, that's how the entire business platform is built on. So I don't know if the three of you have any quick comments, and then we'll move on to other things. So.
I do myself, actually, and I'd like to comment on that. And I definitely shadow and I agree with you, Badri. Yeah, you're not providing car parts. You are providing kind of the whole vehicle. And early on when I was doing the due diligence, I happened to be one of the early adopters, let's just call it.
Yes.
In this platform, I was literally benchmarking software to software. But as I came in and Avestor has evolved, I'll tell you, I'm really jealous from the new people that are setting up their funds right now, because they have a lot more resources available for them. In terms of, like you said, marketing, quickly getting online, being able to bring in deal flow for them, being able to the ecosystem, the engagement with other fund managers, the experience. So really, it's a lot more comprehensive than tool A versus tool B. So I personally double down on what you said, and I believe that the biggest value is really the ecosystem that Avestor is putting together. And it's way more than software. It's way more than tools. It's really the people, the experience, the whole aspects of it in so many different layers. I'm not sure if anybody else in the panel feel the same way or would like to add on that, but for sure, for me, it's really the comprehensive ecosystem.
Yeah, I would like to start out with that. Initially it was the idea of being able to bring in customizable deals and let individuals pick and choose. I mean, that appeared exactly when I needed it. That's what I mean, because I didn't want to create a blind fund where everybody had to be in every deal that was within the fund. And all of a sudden, Avestor made its appearance. And so that's what got me in fairly early. But as the company has expanded, they've added so much more. They've added the community, they added negotiating with sponsors, they've added the bookkeeping, the recommended vendors, the mastermind, the retreat that we went to where we were all able to get together and meet each other in person. There's been so much more that's been going on than just the platform and just the software. And I'm sure it's going to expand and grow as we continue. And as we get to meet each other with different funds, we may be investing in each other's funds or collaborating and doing things in parallel as we are, everybody up on this stage are doing already. So there's a lot more than just the software. So there's, you can't just compare, the software platform.
And I'm going to address that question a little bit differently, Badri, here. And I'm going to, share a little bit of my journey. And you know this well because you have been the firsthand experiencing it, right? So I actually did a lot of, I'm a very analytical person, right? So I did a lot of analysis. I looked at, doing the legal separate, the portal separate. Again, I will not take names, and I thought that I'll just do it myself because, I don't want to pay the platform fees. So, people get a lot. I got hung up a lot on that platform fees, right? So I actually put my deposit in and I came back and I said, no, I don't want to do it because I'm just going to figure it out. I'm just going to do it, right? So I think for BD, you and Jeff, you probably just went head in. But for me, I pulled back. I did, Badri, I hope you remember that.
I do. I was
yes.
in Belgium at the time, but anyway.
Yes. So, and, you guys were amazing in terms of support and helping me understand. But after that, I just went head in and, there's few of the things which is really important that has come out after that also. I just realized that me trying to put together these pieces differently, separately, is just a lot of work. And then, I talked to like CPAs. I paid CPAs to kind of get their consultation, really expert, high quality CPAs. And there are certain things that I came out and it just created a vision for me that basically I'll be ending up spending so much time in doing that fund management, especially if I have an investment which has multiple states in it and the side pocketing. Look it up, that term, side pocketing, by the way. It just makes it so expensive, the whole K1 and everything, right? So for me, then when I went in, I was actually one of the record break, fund managers. It's 2 weeks turnaround time. And you guys did it
too often, then people will come with the expectation we'll do the fund in 2 weeks.
Yes, but of course, you had to be committed that too, right? So essentially, I'm the 50th fund manager on Avesta platform, and the record break timing. I could do it because of you. And a lot of times, people get hung up on, hey, it's my first, first investment, first raise. I'm just gonna do it, just as SPV, probably just spend 5,000. But really think outside the box, people, because that's my kind of, mantra, that you kind of have to look at things differently. You pay for this masterminds and things, and which is kind of like a one-time cost. So, you consider this as a one-time cost. And now you're able to raise for any small raises, even if you're raising 100K, your platform is ready. Can you do 100K, 200K, 300K? Or 500K even without breaking even quickly, even in the SPV model? It's not possible because it's not just the 5,000 cost to start with, but even ongoing. You're gonna have blue sky filings if you're doing 506C. You're going to have the K1. Every single investor, even if he's investing in 5 different investments for you, the CPA has to cut a separate K1 for them. So that's gonna add the cost. So I'm glad for that even now, even for a small raise, I can just quickly go in. And especially, the first time capital raise partners, when I raised capital for the first time, I didn't even get paid for it because I lost my investors and all the problems that we have been talking about, right? So if you're starting small, I think it's really, really important. And few of the things that, but Jeff and BD talked about, this is the mastermind, the community, that's kind of has helped. We were talking about the other group that we have created, right? It's called connectedcapital.fund. By the way, if you're welcome to check us out and join. It's a free group to join, where now we are going beyond that. And Avesta is kind of, ramped up quickly for us because people in that group, what we are doing is we are sourcing deals, we are getting that presented, doing the due diligence together, raising the capital together, right? And we come back and join hands with Avestor to do that together. People who have Avestor platform funds, they're ready to go. People who don't, they have to kind of go through that nuance of, okay, now what do I need to do next, right? And to have that done every single investment, that's going to stop that momentum. So that actually helps a lot for us. So, this whole connected capital.fund community that we have, having Avestor platform funds and so many people from Avestor are there too, it is really, really helpful. So that's one of the biggest thing. I also would add to it that there is a backfill feature, which is a very small feature to think about, but it is big. Because here is what is an example. We all have done raises where we have put our money and kind of backfilled by other investors, maybe 6 months down the line, in 8 months down the line, whatever time it takes, right? What typically happens is that you get the cash on cash, and then once you take out your money and you put investor money, say 3 years later, that investor exits, you don't get any of that share from that 6 months because your money was there, right? So Avestor actually, based on the present value calculation, calculates that, and at the end of that 3 years or 5 years, whenever the investment exit, you will get that portion in that pro rata portion of the time value of the money that you have. So that's a very important feature for me, and I have used it. I have replaced recently, and that was a quick process too. Just the start date, end date, and I've come from the IT background, and that start date, end date, kind of understand it really well. They have done an excellent job about it. I think that's really important.
Thank you, guys. That was a great answer. The one other very quick comment I wanted to mention is we do have a calculator which shows you comparing doing one syndication at a time. And the cost savings come in from 4 primary purposes. It's 1 ppm for any number of deals. It's 1 blue sky filing at the fund level as opposed to doing it for each deal. Less accounting, less taxes, less number of LLCs. But we won't go there. Let me answer some questions very quickly. So we can knock off some very simple ones, and then we'll go into some more complex ones. Do you have to be part of Avestor to participate in that deal sharing Tuesdays? No, but there are some requirements, but you can be outside the platform, but you have to give preferred terms and all that. So you can reach out to me, and happy to talk about it. Here is another easy one. Is Avestor and Synergetic related or different? We are different. I mean, Synergetic is Jeff's fund. So I'm hopefully is a satisfied customer of Avestor. We are not, we don't own Synergetic. We don't have any cross relationship with, like, for example, think outside the stocks is Madhavi's fund. These are all funds on the Avestor platform. We, apart from hopefully being a satisfied customer, we don't have any other relationship as such. So one other question, just in terms of the, well, let me take one more simple one. Is this open to accredited and non-accredited investors? Yes, you can do either a 506B fund or a 506C fund. A 506C fund is open only to accredited investors, whereas a 506B fund is open to non-accredited investors as well. There are some more nuances we can get into, yeah? So, but for now, let me leave it at that. And we do support both 506B and 506C funds. Let's get into some legal issues. So one of the questions is, has this been examined by the SEC? So I want to be crystal clear. We are innovating in a ton of dimensions. I mean, I can go on listing about 15 things which we do, which nobody else does, but that's not for this conversation. But what we don't innovate in is working with SEC guidelines. I mean, we don't want to be the first people to kind of go outside the box for SEC guidelines. Whatever we do is completely conformant to a Reg D framework. And if you're familiar with Reg D, Reg CF versus Reg A, all the funds we do are part of the Reg D framework. And this has been looked at by a dozen SEC attorneys. I mean, the original attorney we worked with was one of the top hedge fund attorneys in Wall Street. We paid over $50,000 for our PPM, or several tens of thousands of dollars. I don't remember the exact amount. So more than a dozen SEC attorneys, including attorneys from the Black Card Club, including, we have our own attorneys, and now we are going to let other attorneys work with our documents and build their own fund. If you don't want to go with our attorneys, you don't have to, yeah? And related to that, another question is there liability across multiple assets? And in general, what we recommend is if you're doing your own syndication deals, by the way, if it's not clear, I know in this case, all the three fund managers here are capital raisers, though Jeff used to be a former, what did he call it? A recovering syndicator? I like that term. This platform can be absolutely used for both doing your own syndication deals and also for raising capital for others. If you do your own syndication deals, we absolutely recommend you put that in separate LLCs. So there is a stone wall between each investment, and the bleed doesn't go across investments. I mean, this is a more complex question, but we can talk about it more individually. I don't want to get into the details of that. And let's see here. Will the investor be responsible if one of your investments fail? How will it impact investors? The investor as an LP is never responsible, has zero liability. I mean, that's not a vestor or anything. If you are investing in a syndication deal and you're investing as a limited partner, if I understand the question right, the only money is at risk is the money you put in. I mean, you can't be liable for something which the sponsor does wrong. And similarly, in the fund of funds manager, in the fund of funds role, if the investor puts in a certain amount of money, then only that money is at risk. He's not responsible if an investment fails. Similarly, a fund manager is not responsible if the investment fails. I mean, let's be clear. They all are doing their due diligence, and at the end of the day, you are taking a risk. And I know how rigorous, especially these three fund managers are in their due diligence. But this is not a bank CD. I mean, this is not FDIC insured. I think you're in the wrong business if you're looking for FDIC insured and if you're looking for a guarantee from the fund managers, unless one of the three of you want to give that guarantee. But I think we'll probably not is the likely answer. Yeah. Let's see here. I think we answered a lot of the questions here in the chat window. One last question: is there still the issue of the late K1s since one is dependent on the lead sponsor team? 100% right. So there is nothing we can do. If your fund has invested in 5 deals, you have to wait until all the 5 deals come in before you issue the K1s. I mean, it is the weakest link, but there's not much we can do about it. We can't generate K1s. We could do that, but you won't be happy with us. But what we have done, in case there is one sponsor who is really, really late, what we have done is if an investor has not invested in the deal, then we have generated the K1s for people who have invested in the other deals, and all the other K1s have come in. And we plan to do that as well. But it is dependent on getting all the K1s, yeah? So, all right. Let's kind of switch gears a little bit. I know you guys talked about a little bit of this. Madhavi, I think this has been a passion of yours. Because you put up connected capital and everything, you and Bobby started that. The question is, how do you choose deals and operators you invest in? I mean, I know the answer might be different from different people, but maybe let's try to do a few more questions. If you any of you want to give some short answers to that, yeah. So
yeah, I can answer that question, and this is the whole purpose of the connected capital.fund, right? That what happens is that we are connected to certain people, right, as an individual. So we have our sphere of network, right? If we have, now we have, say, BD, Jeff here, now it's multiplied by 3, and they might be connected to more. If we keep on multiplying that, the quality of deals and the quality of sponsors that coming to connected capital is going to be humongous. And that's same with Avestor too, right? You have 100+ fund managers there, right? So this is the number one thing, that to get a better quality deal, a better quality sponsor, for us, it starts with sponsor. Because if the sponsor team is good and they are going to be doing a good job at that investment, right? So there's a criteria, and we actually have a criteria which is about 200-point checklist, the due diligence, and each of the area has different kind of due diligence. And when it comes to sponsor, we are most thorough about that, right? So looking at their past record, what their partnership records, what if something happens with them, who will take care of it? So these are the kind of questions we ask, and background check is number one priority, right? That something, even if they are a great group, if something turns up in the background check, we can just, pull out completely, right? Before even we send a dollar of our investor money into it. So we have to be very cautious about it. So that's the thing, that we get first the deals from the best in class sponsors, because when we are doing as a fund of fund platform, we are not the operators. So we want the operators who are going to be very sincere and good at doing what they do, right? The second level is the due diligence. And I was just explaining about that, about 200 point checklist. So the checklist that I had created and I shared with this group, it's essentially not only takes the criteria in mind, but it also tries to give a tangible number to it. So in terms of, getting the rating and the weightage, so that we can come up with a number that, okay, where is this deal actually coming to in terms of due diligence, right? When we are doing this as a group, we can now divide and conquer, because it's humanly not possible for one person, if they are getting 10 deals to their desk and to do this thorough due diligence. The manpower is a problem, but the second problem is that even if the syndicator team is there, are they going to address, if you're a capital raiser and you're bringing more than 50K, and even if you're saying that maybe I'll bring $500,000, this is extensive due diligence checklist. They're not going to be able to answer to that. And they'll, the next question, and I have been asked, I had this checklist for a long time, and I had been asked that, how many millions are you raising when you're asking me so many questions? So that's the second thing, right? The third thing is then, we hit that wall again and again when we are short of that 50K, 100K of that, $500,000 raise, right? So raising it capital together, we have a goal, an objective of whatever, 2 million, 1 million together, it's going to have a high probability of getting it together. So raising the capital together, making a negotiation based on if we raise $1 million, $2 million together, that's what the intention is. So essentially, from sourcing, evaluating it together, raising together, and kind of doing that negotiation with the partners. That's how, I am doing this capital raise. This is how, many people in the community, and so grateful to have people like BD and Jeff in that community, and more managers, right? Because we have seen this for a long time. We ask that right question. Sometimes, I would get surprise question from BD. Sometimes I'll get a surprise question from Jeff, maybe an asset class that I'm not aware of. So that is the power. It's kind of getting that experts together to do the due diligence, because we are responsible for our investors. And we take this responsibility very seriously and as a group. So that's how we are sourcing and kind of getting through these deals.
I mean, the only thing I would reemphasize is, because I believe the question was, how are we finding these deals and how are we getting into these opportunities? And a lot of it is our own networking, our own circles that we're in. But as Madhavi said, as we have more people around that have their own circles and their own network, we'll be bringing in or meeting with more sponsors. And so it's more opportunity. We'll be saying no to a lot more opportunities and a lot more sponsors than we're going to be saying yes to, because we don't have the time, we don't have the ability to go into every deal that we, or we're not going to do the due diligence on every single deal. We want to look at the cream of the crop and start getting better and better deals. And as we go as a community and are doing more deals, we're going to have more people that want to work with us. And, that's part of the investor community, as well as the connected community as well. Meeting more people, having the opportunity to meet with more sponsors. And again, the emphasis is on the sponsor. We're always betting on the jockey first, and then we'll take a look at the horse. But first, we want to know who that jockey is and what their experience is, what their team looks like, how many of these kind of deals they've done before. So many different aspects of it. Go ahead, BD.
Thanks, Jeff. And I could not say it any better than what was already said, other than it's like a self-fulfilling prophecy, because at Bluestone, we're all about our investors, and our goal is always to get the best deals. The unity of these fund managers that you see here on the platform today, as well as all the extended ones that are not here, give us that wide visibility about all the deals. We take our expertise to sift them through. We're like, okay, here's the ones, the top deals that shine. And then we use all our expertise. each one of us has a specific skills in the due diligence, but some of them overlap, which is okay. But there's also a lot of blind sides, where we help kind of complete for each other. So in some sense, that really does nothing but strengthen the quality of the deals we're bringing back to our investors. Because at the end of the day, we want our investors to be successful, and then what we're doing here jointly is really just making them more successful.
And one thing I just want to add to that is the value of the community that's been created both by Avestor as well as the community that's been created by Bobby and Madhavi, is together we could even hire out other professional companies to do due diligence, to do some of the investigation, as we're doing with the background checks, but other aspects of it, to actually be able to afford to pay for expertise, which as a 50K investor, you're not going to go and spend, $1,000 to have somebody do due diligence on somebody. But as a group, we may do that if we feel it's an area that really needs further investigation. We can hire somebody to go out and do this investigation as a community, as a team, working together.
Yeah, and I'll just add one last thing to it, is that, all these due diligence checklists where you can, world is virtual right now, right? It's about you doing this physical the due diligence, which is virtual in the checklist, right? But the physical due diligence of two things is really important, right? One, meeting the sponsor team one-on-one. There's a lot of things that you can actually tell about the people. There's a gut has a brain, right? There's a gut feeling about the sponsor beyond this huge checklist that we have about sponsor. And the second is the walkthrough of the property, right? So that's really important. Somebody to actually go and visit and check it out. And every time you go and kind of cannot buy the ticket and go and visit and tour this facility, the property, right? As a group, whether it's Avestor or whether it's our community, right? If we are going in doing this investment together, somewhere somebody will be close to 1.5 hour distance or driving distance or 2 hour distance, right? They can go meet the team, go look, check out the property. And we are working on one of the investment which BD is leading, the REAP deal that we have. I'm gonna go do a physical due diligence because it's in Dallas. It's a 3-hour drive for me. I'm just gonna meet the team. So that's really important. And the last thing I will say about is that the beauty of this kind of power coming together, the capital raise partners kind of stayed in that center when, the operators, the sponsors thought that, oh, that's not that important. And the investors thought that, oh, I could go directly to the investment. They are not important. We are making that space right now. And when we see each other at the conference, most of the times I see people, oh, you're a capital raise partner. I don't want to talk to you. I want to talk to operator. I want to talk to the investor. But here we are not competing against each other. We are actually coming together. So together we grow. That's really important, whether it's the Connected Capital Fund or whether it's an Avestor community. Together, it's time to put our hands together and grow together. And what we are doing as a community as well, right? We have a deal that we kind of common with Avestor community and our community. Now we can actually come to that threshold a little bit sooner, right? So we are joining hands with Avestor to do that. So it's really important. Don't get caught up with that. What is the fees and what is the cost and this and that. The amount of returns that you're going to get, there's some tangible and there's intangible aspect of it. The intangible aspect of it is really, really powerful. If you haven't seen that and evaluated that, you cannot put a number to it, but this is really powerful.
All right, great answer. I think we are at the hour. Let me take two very simple questions. I guess I'm giving all the complex questions to you and I'm taking the simple questions. Sorry about that. So there was a couple of questions which I think the answer is very simple. Will we get support when we join Avestor? Do you support in PPM, paperwork, structuring the fund? And the answer is, maybe I've not been doing my job, but a resounding yes. We are not just giving you the software platform, we help you with all aspects. So the absolute yes is the answer. So if you want to know more about the platform, or if you want to know more about customizable funds, we do have an ongoing product webinar, and that information has been put in the chat window. And all the panelists have put their, and I have also put my contact information in the chat window. but we'll be sending out a recording of this, and that'll include all the contact information as well. And thank you all for attending. We like to end promptly on time. I'm incredibly blessed to have three very, very talented fund managers join me here. And I appreciate you taking the time. But I will give all three of them one final chance to say any parting words, and we'll call it a day here.
I just say thank you very much for having me, and I am thrilled to be working, on this this platform, and going from operations to being an equity fund manager. I don't know why I didn't do it earlier, but then again, earlier I guess Avestor wouldn't have been around, so I guess the timing was good, but. I have one last property to sell off. If anybody wants to buy a 36-unit student housing outside of Macon, Georgia. But otherwise, once I sell off that property, I'm out of the operations business. Thank you.
All right. Well, very good. Madhavi, BD, did you want to add anything else, or?
I was just giving a chance for Madhavi to go first.
Oh, okay, sorry.
He wants to end with the grand finale. No, I'm so grateful to be here. The fund manager journey is not easy. So if you're thinking that, it's going to be easy for you, it's not. But Avestor makes it easy. So I'm grateful to be in this community, grateful to be on this platform. One last thing I would say is that, whether you're analytical or not, don't get into analysis paralysis, not just for the platform, for everything. Remember that there is a thin line between that analysis paralysis and actually doing it, right? So just keep that in mind. And, scalability is what you want to think about. Community is what you're thinking about. That's the growth there. If you haven't been thinking about joining hands with other capital raise partners, whether you're part of Avestor or whether you're part of Connected Capital Fund, just think about joining hands. These are not the competitors. This is actually your growth together. We all rise with the high tide. So remember that.
Thanks, Madhavi. And I would say, I couldn't say it any better than what Jeff and Madhavi have said, but I just definitely want to thank the Avestor team and Badri for really making it easy for us to do our job. And, if our focus is really all about our investors and the enablement, it's really all there. For people that are coming right now, like I said, they're in much better shape than what it was 2 years ago.
True.
the tool is better, the experience is better, the all aspects about becoming a fund manager is so much lower barrier now than probably what it was 2 years ago. The team at Avestor working diligently to ensure that every time we encounter an issue, they're coming in and solving and providing solutions. And I think, their background in terms of creating a fund as a trial run, figuring out, hey, what are some of the pieces that are needed, and then going back and doing it. I don't think any other software company has done that. So it's way more than just, like I said, a software platform. It's really developed from the ground up as a fund manager and saying, okay, here's all the pieces that a fund manager need to be successful to do their role. So big thanks to Avestor, the community. I'm actually very happy to be part of this community and getting to know more and more fund managers to doing more work together, like Madhavi and Jeff and others.
And just to finish that off, this is the only platform that really is focused in on working with fund managers, making sure that they stay compliant, reminding them of compliance issues or anything that we need to do, or new legislation that comes up, and different things that we need to do. So it's really focused in on fund managers and different funds, where the other platforms, may be able to work with you, but the focus is not fund management. They put a lot of effort into that.
And one philosophy that I have is when I'm investing, right, about sponsors. I like sponsors to make money, because then they're going to have that vested interest in the investment, right? They need to be successful for us to be successful. So I like to think about the fund management platform also like that. There was a recent platform which just collapsed, And so many funds on it, it just didn't survive because they didn't have this right financials to back in, or whatever that reasons were, right? So I think it's good that Avestor is sustaining because of the financials, and they're able to add so much value to fund managers. So that's really important aspect.
All right. On that note, thank you, everybody, and appreciate you joining. Enjoy. I guess we are not quite near the weekend. I'm wishful thinking here. We still have a few more days to go, but enjoy the rest of the week, and hope to see you. And we are planning to do this regularly. And this is going to be a monthly webinar, not to be confused with the product webinar, which will be more of a demo of Avestor and the value prop of Avestor. So I do hope you can join us in future webinars. And again, great round of applause for the three panelists. They come from diverse backgrounds, and I think I've done a great job in setting up their funds. Thank you all.
Thank you for having us. Thank you. So grateful, and grateful that each one of you lasted here too. So thank you so much. So grateful.
Thank you very much.
Thank you.